The last few weeks have seen markets surge on expectations that the Federal Reserve will start to make rate cuts in 2024. This has mainly been driven from cooling inflation and comments made by Jerome Powell about rate cuts, with the narrative seemingly moving towards everyone thinking that inflation has now been defeated. However, when we take a deeper dive into some key forward-looking indicators surrounding inflation and economic activity in general, there are clear red flags to suggest that this may not be the case at all. There are in fact a number of signals pointing towards prices rising again in 2024, which would push CPI back up towards the highs that we saw last year, and this upwards movement would only be amplified if aggressive rate cuts are to come alongside it. We are therefore approaching a pivotal time for the economy in which the Federal Reserve is in real danger of completely derailing the economy. So this pivot by the Fed was triggered mainly by CPI coming in under expectations, which prompted the Federal Reserve to hold interest rates static at 5.25%, with the market reading this alongside some of the comments that Jerome Powell made as a dovish pivot. And FOMC members are now predicting that rates will fall to 4.5% approximately in 2024, and the market is certainly now pricing in rate cuts next year as we saw stock prices and bond prices surge. The problem is that inflation data from the past is a lagging indicator and therefore is not indicative of what is going to happen in the future. Central banks have a tendency to focus too much on lagging variables like this rather than forward-looking variables when it comes to monetary policy. And despite CPI falling dramatically in recent months, the forward-looking metrics that forecast where CPI is likely to head next are suggesting that this downwards trend is about to be reversed. Let's start off by taking a quick look at this chart showing CPI data from the past 10 years, represented by the red line, mapped onto CPI data from the 1970s. And the 1970s was a decade which saw inflation make new highs after excessive quantitative easing from the Fed, followed by steep interest rate hikes from lows of 3% to an initial peak of 11.22% to fight this inflation. Now, once inflation came back down, the Fed believed that they had beaten it, and a premature all-clear was given, which saw interest rates get cut drastically. However, inflation was not in fact beaten, and it began to surge shortly after rates had been cut, reaching an even higher peak than what had just been reached, as you can see by the red arrow. The path that we are on today is eerily similar to this period in the 1970s, both in terms of Fed behaviour when it comes to monetary policy, as well as how closely the CPI data is mirrored when charted next to each other. Inflation is much more of a lagging variable than many other key economic metrics, and it typically bottoms out in the middle of expansions and peaks during recessions. So the first forward-looking indicator that is a red flag to suggest that inflation is not defeated at all is the Global Supply Chain Pressure Index, which takes into account transportation costs and manufacturing data and indicators to get a gauge of how much stress global supply chains are under right now. Now, if this index is rising, then it suggests that there is an increase in supply constraints across the economy, which can lead to upwards pressure on product prices driven from the supply side. We are all aware of how much pressure was put on global supply chains during the pandemic, when most of the world did shut down, as this is represented with a significant surge in the index during this time period. The index has since plummeted back down to more normal levels. However, in recent months we have seen a complete trend reversal, with the index starting to rise back up significantly, representing a spike in supply chain pressure. When we map CPI on top of this Global Supply Chain Pressure Index, we can see that there is a very close correlation between these two. As the Supply Chain Pressure Index rises, we see CPI also rise to follow it, just lagging behind by a few months. The pandemic years are a perfect example to show this correlation and relationship between these two metrics, with the Supply Chain Pressure Index peaking in December of 2021, while CPI didn't peak until June 2022, 6 months later. This Supply Chain Pressure Index is a great metric to foreshadow where CPI is heading in the next few months, and this recent surge that we have seen in it is not good news for inflation, as it suggests that prices could be about to start rising yet again. The current conflicts around the Middle East and the Red Sea are definitely contributing towards this recent spike that we have seen, and the longer that this conflict goes on for, then the more disruption and pressure we are likely to see impacting supply chains. Wage growth could also contribute to rising inflation in 2024, with leading indicators suggesting that wage growth is about to accelerate next year. For the last year or so, wage growth has been falling sharply despite remaining positive in real terms, However, the NFIB survey on compensation plans is pointing towards wages starting to pick up speed next year. Also, the Fed Regional Wage Survey is looking very strong and has spiked in recent data points, reversing this downtrend that we're seeing in wage growth. This Fed Regional Wage Survey leads average hourly earnings by approximately 6 months, looking at this chart comparison, so the signs are definitely pointing towards rising wages in 2024. If people are earning more money next year, then this will of course mean that there is likely to be a high demand for goods and services across the economy, putting upwards pressure on inflation from a demand side as well. And in fact, we're already starting to see food prices heading upwards on a year-over-year basis, which is yet another indicator which leads CPI by between 6 months to 1 year. As we know, with the supply chain pressure rising as well, this is likely to keep pushing food prices up, which has historically led to rising CPI later down the line too. On top of this, there are a few other forward-looking metrics that suggest an uptick in inflation on the horizon, including the US Inflation Expectations Index and also the Chinese PPI numbers that have ticked upwards too, as China has historically been one of the key drivers of disinflation across the world, so this going up is not a good sign. At this point, we really have to start to consider whether there are other reasons why the Fed is turning a blind eye to these forward-looking indicators and looks to be going ahead with rate cuts anyway in 2024. It seems obvious from the data that inflation has not yet been defeated, and there could be lots of big trouble ahead if rates do get cut next year, potentially even leading to a new peak in CPI if we do indeed continue to follow the trajectory of the 1970s. One big reason why the Fed's hand could already be forced into making rate cuts is just how insane the debt crisis has become, which is putting massive pressure on many areas of the economy. Now, government debt continues to smash through new all-time highs pretty much every month, surging at a pace that we have never really seen before in modern times. The rate at which this debt has been accumulated by the US government has led to the cost of servicing this debt also spiking too. And interest rate payments on debt is now the third highest spending category for the government, who are now spending more money on this compared to things like health and Medicare. This sky-high debt spending is a contributing factor towards why the government budget deficit is getting bigger and is now at one of the largest deficits that we have seen in history. We also know that banks have been struggling a lot with the current high interest rate environment. A lot of their assets are in bonds and loans, all of which have lost a lot of value throughout the rate hike cycle, inflicting extremely large unrealised losses and putting major stress on some of the smaller regional banks that have also seen bank runs take place. We've of course even seen some of these regional banks go completely bankrupt and collapse earlier this year. Making aggressive rate cuts would relieve some of this pressure on the banking sector, and if the Federal Reserve has been made aware that some banks are in big trouble at the moment, then this may push them towards these rate cuts being aggressive next year. Of course, this may not be the case at all, but the point is that making rate cuts would actually help out a lot of these organisations operating in the loan and debt market, at least in the short term. And this could be a driving factor behind why the Fed could be ignoring some of these forward-looking inflation indicators for the sake of helping out the rest of the economy. A specific area of the economy that looks to be in a bubble right now and on the brink of a collapse is the housing market. There are a number of metrics suggesting that we could see major weakness in the housing market next year, which could lead to a big correction. I cover this in more detail in my previous video, which you can check out by clicking on screen right now. And aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot. And thanks a lot for watching.